They told you the banks are safe now, stricter regulations, better capital ratios, less risk on their balance sheets. They are right, the banks are safer, because the risk left. It migrated to a $2 trillion shadow banking system that operates outside regulation, outside oversight, and outside the rules that govern traditional banks. And right now, that shadow system is running the largest accounting illusion in financial history. They are pretending zombie companies are alive by creating phantom interest that exists only on paper, and your pension fund is paying for the charade. This is the story of the shadow banking trap, the invisible mechanism by which post-2008 regulations pushed credit risk out of banks and into an unregulated parallel financial system. In this investigation, we are going to show you how private credit funds lend $2 trillion to companies at floating rates tied to SOFR. We are going to explain the PIK loophole that allows these funds to hide defaults by converting unpaid interest into phantom debt. And we are going to walk through the cascade that unfolds when pension funds try to withdraw their money and discover the cash does not exist. This is not about bank safety. This is about where the risk went when it left the banks. Educational analysis only, not financial advice. To understand what is breaking, you need to understand how credit markets restructured after 2008. The financial crisis was a banking crisis. Lehman Brothers, Bear Stearns, Washington Mutual. Banks failed because they made bad loans and held them on their balance sheets. The response was regulation, Basel III capital requirements, stress tests, liquidity coverage ratios. The goal was to make banks safer by forcing them to hold more capital against risky assets. The regulations worked, banks became safer. But the regulations did not eliminate the demand for credit. Middle market companies still needed loans. Private equity firms still needed leverage for buyouts. Real estate developers still needed construction financing. If banks could not provide that credit profitably under the new rules, someone else would. Enter shadow banking. Not banks in the traditional sense, but funds that perform bank-like functions, private credit funds, business development companies, direct lenders. They raised money from institutional investors, pension funds, insurance companies, endowments, family offices. They promised high returns, 8 to 12% annually when treasury yields were near zero. And they deployed that capital into loans. Loans to companies that were too small for the bond market and too risky for the newly cautious banks. The shadow banking market grew explosively. In 2010, private credit assets under management were roughly $200 billion. By 2024, the market exceeded $2 trillion, a tenfold increase in 14 years. This was not a niche. This was a systemic shift. Credit was no longer intermediated primarily through regulated banks. It was intermediated through unregulated funds operating in the shadows. Here is the key structural detail. Unlike bank loans, which are often fixed rate or have interest rate caps, private credit loans are almost entirely floating rate. The structure is simple. SOFR plus a spread, SOFR plus 5%, SOFR plus 6%. When SOFR was at 1%, a SOFR plus 5 loan cost the borrower 6%. Manageable for most middle market companies. But SOFR does not stay at 1% forever. In video 7, we analyzed the SOFR spike. On January 22nd, 2026, SOFR jumped to 5.43% overnight, a 12 basis point move that repriced $600 billion in floating rate consumer debt. Credit cards, HELOCs, auto loans. But the bigger impact, the one that no one was tracking, was in private credit. Let me show you the math. A company borrowed $100 million in 2021. The loan was structured as SOFR plus 5%. At the time, SOFR was averaging around 1%. The company's all-in interest rate was 6%, $6 million per year in interest expense. The company generated $10 million in EBITDA. After interest, they had $4 million for other obligations, tight but workable. Now it is 2026. SOFR is 5.43%. The same loan now costs 10.43%. The company's annual interest expense is $10.43 million. But EBITDA has not doubled. It is still $10 million, maybe $11 million if they grew modestly. The company cannot cover the interest. They are insolvent on a cash flow basis. They should default. The lender should recognize a loss. The fund's NAV should drop. Investors should be informed. But none of that happens. Why? Because of a loophole called PIK, payment in kind. PIK is an accounting structure that allows a borrower to pay interest not in cash, but by adding the interest amount to the principal balance of the loan. It sounds technical, but the effect is profound. It turns a cash crisis into a phantom asset. Here is how it works in practice. The company from our example cannot pay the $10.43 million in interest. The loan agreement has a clause that allows the lender to amend the terms. This is called amend and pretend in the industry. The lender calls the borrower. We understand you are under stress. We are going to help. Instead of paying us cash interest, we will convert the interest to PIK. The loan balance will increase by the interest amount. You stay current. We avoid a default. Everyone wins. The company agrees. They have no choice. Default means bankruptcy. PIK means survival, at least on paper. The loan balance goes from $100 million to $110.43 million. Next year, the interest accrues on the new balance. $110.43 million times 10.43% equals $11.5 million. That gets added to principal. The loan is now $121.9 million. The year after, the interest is $12.7 million. The loan becomes $134.6 million. This is exponential growth. The debt is compounding at over 10% per year, and no cash is changing hands. From the lender's perspective, this is a gift. They can still report the interest as income on an accrual basis. The fund's NAV, which is based on the marked value of the loan portfolio, does not drop. In fact, it goes up. The loan balance is increasing every year. The fund reports an 8% annual return to investors. Pension funds see steady performance. They stay invested. They do not redeem. The illusion holds. But the illusion has a fatal flaw. There is no cash. The company is not generating the cash flow to service the debt. The principal is ballooning. At some point, the loan matures, or the company needs to refinance. And when that moment comes, reality intrudes. No one will refinance a $135 million loan on a company that generates $10 million in EBITDA. The debt-to-EBITDA ratio is 13 times. That is distressed territory. The company defaults. The lender takes a massive loss. But by then, years have passed. The fund has collected fees, the managers have taken their carry on the phantom returns, and the pension fund is left holding the bag. Let me walk you through the cascade. This is not theory. This is the documented sequence playing out in the private credit market right now. The SOFR spike hit in early 2026. By mid-2026, industry estimates suggest that 30 to 40% of private credit loans have converted to full or partial PIK. That is $600 to $800 billion of loans where interest is no longer being paid in cash. It is being accrued as phantom debt. The companies are zombies. They are generating just enough cash to cover operating expenses, but not debt service. They are being kept alive by the PIK structure. This is not limited to a few bad loans. This is systemic. The entire private credit market was underwritten in a low-rate environment. SOFR at 1%. When SOFR quintupled, the entire portfolio became uneconomic. Lenders cannot admit this. Admitting it means marking down the portfolio. Marking down means investor redemptions. Redemptions mean having to sell loans in a distressed market. Selling means realizing losses that wipe out years of fees and returns. So they pretend, they pick the interest, they report stable NAVs, they hope rates come down before the loans mature. Who are the investors in these private credit funds, pension funds, insurance companies, university endowments, sovereign wealth funds? But the largest category is pension funds. They invested heavily in private credit starting around 2015. Why? Because they needed yield. Public pension funds are underfunded by approximately $1.5 trillion nationally. They have obligations to retirees that exceed their assets. To close that gap, they need high returns. When Treasury yields were 2%, that was impossible in traditional fixed income. So they allocated to alternatives. Private credit promised 8 to 12% with low volatility and low correlation to public markets. It looked perfect, but the assumptions were wrong. Private credit is not low volatility. It is low transparency. The NAVs are marked by the fund managers, not by the market. There is no daily price discovery like stocks or bonds. The funds report quarterly, and they report what they want to report. As long as loans are accruing interest, even if it is PIK, the NAV can stay stable or even rise. The pension fund sees an 8% return. They think the investment is performing. They allocate more capital. By 2024, some pension funds had 10 to 15% of their portfolios in private credit, billions of dollars locked in illiquid loans to over-leveraged middle-market companies. Pension funds have a timing problem. Retirees are withdrawing benefits. Every month, cash goes out the door. The fund needs liquidity to meet those obligations. In normal times, they sell liquid assets, stocks, bonds, treasury bills. But if the stock market is down and bond yields have risen, those assets have lost value. The pension fund needs to maintain its asset allocation, so they look at their private credit allocation. It shows an 8% return. It looks like the best performing asset. They decide to redeem some of that capital to rebalance the portfolio. The pension fund calls the private credit fund. We need to redeem $50 million. Please process the redemption by quarter end. The fund manager has a problem. The loans are PIK. No cash is coming in. The loans are illiquid. There's no secondary market where the fund can sell a $100 million loan to a zombie middle market company. The only way to generate cash is to force the borrower to refinance or sell the company. But the borrower cannot refinance. The debt is too large. The company cannot be sold. No buyer wants a company with 13 times leverage and declining cash flow. The fund manager has two options: admit the problem or delay. Most choose delay. They invoke a redemption gate. This is a clause in the fund documents that allows the manager to limit redemptions to a certain percentage of NAV per quarter. We're experiencing elevated redemption requests. To protect all investors, we are limiting redemptions to 5% of NAV per quarter. Translation: you are stuck. Your 50 million redemption will take 5 years to process, and by then, the NAV will have been marked down and you will get far less than 50 million. Once redemption gates go up, the illusion breaks. Other investors see the gates, they realize the fund has a liquidity problem, they submit their own redemption requests. The queue grows. The fund is forced to sell whatever it can. It sells the few performing loans at a discount just to raise cash. This crystallizes losses. The NAV starts to drop, from par to 95, then to 90, then to 85. The pension fund that thought it had 100 million in private credit now has 85 million, and it still cannot get the cash out. As the NAV drops, the fund has to mark the remaining loans. If one loan sold at 70 cents on the dollar, the fund has to mark similar loans at 70 cents. The entire portfolio reprices down. The NAV crashes from 100 to 70 in a matter of quarters. The pension fund takes a 30% loss. This is not a mark-to-market loss on a liquid asset they can write out. This is a permanent impairment on an illiquid asset they cannot exit. One fund's NAV collapse does not stay isolated. Pension funds invest in multiple private credit funds. If one fund is marking down, the pension fund asks the others, why is your NAV still at par when Fund A is at 70? Pressure mounts. Other funds start marking down. Industry-wide, NAVs drop. Pension funds across the country recognize losses. The 1.5 trillion underfunding becomes 1.8 trillion. States face a choice: cut benefits, raise taxes, or seek federal bailouts. None of these options are popular, but one of them is inevitable. But here is the deeper problem. The private credit market is not just a pension fund problem. It is a corporate zombie problem. These companies that are being kept alive by PIK are not restructuring. They are not cutting costs. They are not innovating. They are just accruing debt and waiting for rates to drop, waiting for a miracle. And while they wait, they are not hiring. They are not investing. They are not growing. They are economic dead weight. And when the PIK finally stops and they default, they will lay off workers, shutter facilities, and leave suppliers unpaid. The real economy cost is enormous. Let me translate the shadow banking collapse into personal impact. Because when pension funds take 30% losses on private credit, the consequences land on you. Your pension benefits get cut. If you are in a defined benefit pension plan, your monthly payment in retirement is supposed to be guaranteed. But pension funds are not actually guaranteed by anyone except the pension fund itself. If the fund is underfunded and takes massive losses, the only way to restore balance is to cut benefits. This has already happened in some states. Retirees who were promised $3,000 per month are now getting $2,500. The cut is permanent. There's no makeup payment. Your retirement income just dropped 20% because the pension fund chased yield into private credit and got trapped. Your contributions increase. If you're still working and contributing to a pension, the fund will need more money to close the gap. Your paycheck deduction goes from 5% to 7%, or your employer reduces other benefits to fund the higher pension contribution. Either way, your take-home pay falls. Your 401k takes hidden losses. If you have a 401k, check if you have an allocation to alternative investments or private equity to credit. Many target date funds now include a small allocation to illiquid alternatives. If that allocation is 10% and it loses 30%, your overall portfolio is down 3%. That might not sound catastrophic, but if you are close to retirement and were counting on that money, a 3% loss on a $500,000 portfolio is $15,000. That is 6 months of retirement spending. Your taxes increase. When public pension funds are underfunded, the state has to make up the shortfall. That money comes from the budget, either through higher taxes or cuts to other services, schools, infrastructure, public safety. You pay either way: higher property taxes, higher sales taxes, or worse services. Your employer's pension liability grows. If you work for a company with a defined benefit pension, the company has to fund the shortfall. This comes out of profits. Lower profits mean smaller bonuses, smaller raises, and potentially layoffs. The pension crisis becomes an employment crisis. This is the wealth transfer. The shadow banking system promised high returns with low risk. Pension funds believed it. They allocated billions. The returns were an illusion, phantom interest accruing on unpayable debt. When the illusion breaks, the losses are real. And the losses are borne by retirees, workers, and taxpayers. We have mapped the shadow banking trap, the post-2008 migration of credit risk from regulated banks to unregulated private funds, the floating rate structure tied to SOFR, the PIK loophole that hides defaults by creating phantom debt, the pension fund exposure, the redemption crisis, the NAV collapse, Each stage is mechanical. Each stage is measurable. And the early warning signs are visible. So how do you know when the shadow banking crisis is transitioning from hidden stress to visible collapse? There are 3 signals to watch. Business development companies are publicly traded. They are required to report their NAV quarterly. They invest in the same middle market loans as private credit funds. They use the same structures. They face the same SOFR exposure. But because they are public, their marks are scrutinized. If a major BDC reports a 10% NAV decline in a single quarter, it means they are recognizing losses. It means PIC is no longer hiding the defaults. And if BDCs are marking down, private funds will be next. Watch tickers like ARCC, Maine, BXSL. If their NAVs drop sharply, the crisis is going public. If a fund managed by a major firm, Apollo, Blackstone, KKR, Ares, announces that they are limiting redemptions, the crisis is acute. Redemption gates are the nuclear option. Funds only use them when they cannot meet withdrawal requests. When a gate goes up, it confirms that the loans are illiquid, the cash flow is phantom, and the investors are trapped. Other funds will follow. Watch for press releases with language like temporary suspension of redemptions or orderly redemption queue. That is code for we do not have the cash. CalPERS, CalS TRS, New York State Common, Illinois Teachers. These are some of the largest pension funds in the country. They have billions in private credit. If one of them announces a material write-down, say marking their private credit allocation down from par to 80 or 70, it forces other pensions to reassess. Pension fund accounting is based on peer comparisons. If CalPERS marks down, every other pension fund with similar exposure will face pressure to mark down. This is the moment when the systemic loss is recognized. Watch pension board meetings and financial statements. A write-down by a major fund is the signal that the house of cards is collapsing. Watch for these 3. If you see one, the stress is real. If you see 2, the crisis is spreading. If you see all 3, the shadow banking system is in full collapse, and your pension is in the blast radius. This has been the anatomy of the shadow banking trap. In 2008, the crisis was in the banks. The response was regulation. Make banks safer, hold more capital, pass stress tests. The banks complied. They are safer. But the regulations did not eliminate risk. They displaced it, from banks to shadows, from transparent balance sheets to opaque fund structures, from cash-paying loans to phantom interest accruals. We connected the dots. In video 7, we showed you the SOFR spike, 12 basis points, invisible to most people, but devastating to floating rate borrowers. This video showed you where those borrowers are, in the private credit market, $2 trillion of loans that cannot be serviced at current rates. And we showed you how the losses are being hidden. PIK, payment in kind. Phantom interest that exists only on paper. Debt that compounds but never gets paid. The trap is structural. Private credit funds cannot admit the losses without triggering redemptions. Pension funds cannot redeem without forcing the funds to mark down. And when the marks come, the losses are catastrophic. 30 to 50% of NAV in some cases. Hundreds of billions of dollars of phantom assets evaporating. This is not the banks failing. This is the shadow banks failing. And the shadow banks are funded by your pension. The risk left the regulated system. But it did not disappear. It mutated. It hid. And it grew. Now the SOFR shock has exposed it. The PK clock is ticking. The redemption gates are coming, and the shadows are about to collapse into the light. Stay informed. Watch the signals. And remember, when regulators solve one crisis by pushing risk somewhere else, they do not eliminate the crisis. They just delay it. And the delay makes it worse.